The NYSE American is currently closed for trading. The last closing price for Nuburu Inc. (BURU) on Monday, October 27, 2025, was $0.3950 per share, reflecting a minus 1.25% change from the previous close. After-hours trading activity saw the stock move to $0.3850. What is absolutely crucial to understand about this stock right now, and what most casual onlookers completely miss by focusing on the sub-dollar price tag, is that Nuburu Inc. is not the same company it was even 6 months ago. The general market narrative, the expectation, is that this is a failed SPAC, a pure-play, pre-revenue blue laser technology firm with constant dilution risk, struggling to commercialize its high-power welding and 3D printing lasers. That's the superficial reality of the ticker symbol's history. But the deeper reality is that the company is undergoing a radical life-and-death strategic transformation that has seen it pivot hard toward the defense and security sector through a series of rapid, planned acquisitions and joint ventures, essentially aiming to become a defense tech holding company, leveraging its core blue laser IP in new, high-margin government and military applications. This move is the core tension for BURU, a complete reinvention that is driving the recent explosive volatility and trading volume far eclipsing the fundamental value of its original business. This pivot isn't just a new marketing slogan, it's a total refocusing of capital, management, and intellectual property. The price action, which has shown massive swings, including a dramatic increase of nearly 189% over the last month, despite the poor financials, reflects this narrative tension. Investors are weighing the high risk of a deep turnaround strategy against the potential high reward of a successful entry into the lucrative defense tech space. The recent stock movement for Nuburu Inc. has been nothing short of a roller coaster, dominated entirely by news flow surrounding their acquisition strategy and subsequent financing efforts. In late September and throughout October 2025, the stock was incredibly active, frequently appearing on high-volume lists. This isn't institutional accumulation in the traditional sense, but rather a frenzy of speculative retail trading fueled by announcements. For example, the news that they successfully raised $12 million in a public offering in mid-September to fund the strategic shift was immediately followed by a steep increase, a classic case of capital infusion being viewed as a lifeline, even though it meant significant shareholder dilution. Then the flurry of announcements regarding the proposed acquisitions of companies like Orbit, a software-as-a-service company specializing in operational resilience, and the strategic alliance with Maddox Defense for a controlling interest joint venture to advance next-gen drone technologies, created powerful short-term momentum. These are tangible, defense-oriented deals, and they've captivated a certain segment of the market looking for highly volatile, high-alpha speculative plays, far removed from the stable returns sought on platforms like Fidelity or even through robo-advisors like Schwab Intelligent Portfolios. The trading volume has been massive, with figures often in the tens or even hundreds of millions, which for a stock with a tiny market capitalization signals extreme short-term speculation. The recent low price is also a function of the company having to secure its NYSE American compliance following earlier concerns, a necessary step that often requires a reverse stock split or other capital restructuring moves that keep sophisticated individual brokerage clients and institutional funds nervous about the underlying stability regardless of the perceived upside. Let's be clear about the business model before the pivot. Nuburu was founded in 2015 and built its technology around high-power, high-brightness blue lasers. This blue light technology is genuinely unique because it interacts with highly reflective materials like copper, gold, and aluminum with significantly higher absorption rates than traditional infrared lasers. This makes it theoretically ideal for high-speed, high-quality welding and 3D printing in key growth industries such as electric vehicle battery manufacturing, consumer electronics like smartphone components, and aerospace. They possess a substantial intellectual property portfolio, over 220 patents granted or pending, which is their single most valuable non-cash asset. Revenue from this core blue laser business, however, has been minuscule, demonstrating the immense difficulty in achieving commercial-scale adoption in industrial settings. The cost of goods sold and massive research and development expenses mean the company has historically operated at a substantial net loss, burning through cash. The original expectation was that the EV boom would pull them into profitability. The reality was that the adoption cycle for their industrial product was simply too long, estimated at 22 to 24 months per customer, a timeline they couldn't survive on meager revenue. This is why the management team, under the new dual CEO structure, felt compelled to execute a radical shift. The core of the new reality is the Defense and Security Hub strategy. The idea is to acquire established or near-commercial defense and security technology companies, instantly gain revenue and contracts, and then integrate their proprietary blue laser technology into these new platforms for specialized applications like drone defense, electronic devices for defense and security, and advanced telecommunications. For instance, the acquisition of Orbit and the controlling interest in the JV with Maddox Defense aims to give them immediate access to operational resilient software, drone platforms, and military vehicle outfitting, allowing them to cross-sell or integrate their unique laser capabilities. They are trying to shortcut the long industrial sales cycle by plugging into the much faster-moving and much higher-margin government contract cycle. The reported cash position of approximately $6 million following the recent financing is earmarked specifically for deploying this acquisitions program. This strategy is a very high-risk, high-reward bet. The expectation being set by management is a rapid turnaround, with projected billings of approximately $500,000 in Q4 2025 from the defense operations and a robust revenue-generating foundation in 2026. The reality is that integrating multiple companies, especially across different sectors and international boundaries like their existing relationship with the Italian defense tech company Tecna SPA, is incredibly complex, fraught with integration risks, and highly dependent on successfully securing and executing large government contracts. The volatility is compounded by the fact that Nuburu is a low-float stock with very little institutional ownership. When a stock has low institutional backing, price movements are often disproportionately influenced by retail traders and momentum-driven algorithms. You see this phenomenon across many low-price stocks traded on apps like Robinhood, where the accessibility of fractional shares and zero-commission trades can amplify short-term swings based on headlines alone. The lack of a major institutional backstop means there's no large capital pool committed to stability, allowing the stock to rise and fall dramatically on rumor and news. When considering an online investment in something this volatile, it moves beyond typical stock analysis and requires an almost binary view. Will the defense tech pivot succeed and deliver the projected revenue, or will the acquisition costs and continued dilution eventually wipe out shareholder value? Looking ahead, the future outlook for Nuburu Inc. is entirely tied to the execution of this defense tech pivot. The expectation is that the company will quickly finalize its planned acquisitions, start consolidating their revenues, and transition from a struggling laser firm to a diversified, high-margin defense tech player. Key catalysts to watch for are the final binding agreements for the proposed acquisitions, especially the one involving an accelerated defense application of their blue laser, and the actual reporting of revenues from their new Defense and Security Hub. If Q4 2025 earnings show meaningful new revenue from the defense sector that begins to offset the massive operational expenses of the legacy laser business, the stock could find a more stable, higher trading range. The risks, however, are substantial and represent the true reality challenging the high-flying expectations. First, the company still faces the threat of further significant dilution to fund ongoing operations and complete the multiple acquisitions. They have a history of leaning on equity financing, which continuously shrinks the existing shareholders' piece of the pie. Second, the integration risk of merging different companies with varying corporate cultures, financial systems, and management teams is huge. If the synergies don't materialize quickly, the added costs will only accelerate the cash burn. Finally, the blue laser technology itself still needs to prove its worth in the new defense applications. It is the underlying value driver for the whole structure, but if it remains confined to early-stage, low-volume military projects, the original commercialization problem is simply traded for a new one. This is not the kind of stable, diversified asset holding one would find in a portfolio of Fidelity ETFs or SoFi Invest's robo-advisor offerings. This is pure, high-stakes speculation. In summary, the narrative tension surrounding